Hi and welcome to MBA Now. I'm Rob Van Raphorst. Interest rates have a big impact on the mortgage industry. Here to talk about that and Federal Reserve policy is Lynn Fisher, MBA's Vice President of Research and Economics. Lynn, thanks for being here. This question might seem a little obvious, but why are interest rates so important to the mortgage industry?
Sure, there's a number of ways in which they impact bankers and mortgage lenders. The biggest one is volume of mortgage applications that they're going to see. Refinances in particular are going to tick up in times when interest rates fall. To a lesser degree, it'll impact the volume of purchase applications that lenders see. You know, people tend to make purchase decisions for other reasons, not just interest rates. But also, if you think about the business of mortgage lending, there's an impact of interest rates on the pipeline and perhaps on hedging activity that lenders conduct. It also affects the value of mortgage servicing rights, right? Because it affects the interest rates affect the prepayment rate that servicing rights are going to see, and that affects their value. And it also affects the liquidity of those mortgage servicing rates because as expected prepayment speeds fall, that makes it a more interesting asset to hold, and so more people tend to be in the market for them.
So we've seen the Fed raise rates a few times in the last 6 months, but that hasn't always translated into mortgage rates going up. Can you explain why that is?
Sure, Rob. There's a lot of different forces that act on the 30-year fixed rate mortgage rate. It certainly is tied to short-term rates, and that's the lever that the Fed is using right now. But at the same time, 30-year fixed rates are also tied to 10-year Treasury yields. And those yields can be influenced by investors from all over the world. So in times of greater geopolitical risk, we tend to see investors move out of equities and into safer bonds, especially U.S. securities. And so that can push interest rates in the opposite direction, even though we know short-term rates are slowly going up. Investors have also sort of reapprised how they believe the Trump administration will be successful over the coming years, and things like that also have impacts on 10-year Treasury yields. So while 30-year fixed-rate mortgages are slowly going to trend up, there could be periods in which the 10-year Treasury yield comes down, and that'll pull mortgage rates down in the short term.
So the Federal Reserve does more than just set interest rates. What other announcements should our members be on the lookout for?
Sure. So in addition to setting short-term interest rates, the Fed also, in their quantitative easing moves, started buying U.S. Treasuries and mortgage-backed securities. And so one of the things we expect to hear more from the Fed about as the year moves forward is how they expect to start unwinding their portfolio of securities and MBS. That could have a couple of impacts on mortgage markets. It could cause greater volatility in rates. We might see spreads widen a little bit between the 30-year fixed-rate mortgage and the 10-year Treasury yield, maybe as much as 15 basis points. So we'll keep an eye out for additional announcements from the Fed on exactly what their plans are.
Great. Thanks so much for explaining all that to us. I know it's a big part of our industry.
You're welcome.
Be sure to follow us on Twitter at MBA Mortgage and like Mortgage Bankers Association on Facebook and Instagram.